A lot of people think of mortgage insurance as if it's a waste of money, right? So burn your money equals mortgage insurance. Annabelle and I are going to prove to you today that it ain't the case. Most people come to me as a lender, wanting to put as much money down as possible so they avoid paying mortgage insurance because they think it's a complete waste of money, it's unnecessary, and mortgage insurance is not their friend. Well, listen on. You're watching and listening to the Ask Ella podcast, and today I have the amazing Annabelle Silva with ArchMI, and we're going to talk about what exactly makes the MI not your enemy, why you need MI, and how MI can actually help you, the home buyer. So, Annabelle, tell me your story. How did you end up in this crazy biz of ours?
Thank you, Ella, for having me. Nobody grows up thinking they're going to be a loan officer or an insurance rep. I had the privilege of my previous boss considering me and got me into the ArchMI space. And I think it's important that people have the knowledge of what is needed because it takes all the parties. It takes a good loan officer. It takes a good title company, a good appraiser, a good realtor. And sometimes we forget about the backside with processing, underwriting, and mortgage insurance is a partner with that. So we're a security that helps insure the loan, we help underwrite the loan, and it gives buyers other options besides VA, FHA, which are still good options, but we have another option that doesn't require 20% down, even 10% down. You can get in as little as 3% down for that home, and it helps you get in faster as opposed to waiting to save for a down payment while prices are rising.
Good grief, girl. I mean, you just nailed it, and you took the wind out of my sails there for a second. So let's start with probably a dumbish question, but I think that's what everybody wants to know. Why do I need mortgage insurance? Because again, most people come to me as a lender wanting to avoid it, thinking it's their enemy. So why? Why mortgage insurance? What is mortgage insurance, more importantly? And we'll roll into more questions, but I think this is the biggest one that everybody wants to know.
Absolutely. And as you said, mortgage insurance is your friend. It allows you to get into a home sooner with less money down. Where FHA is upfront insurance and monthly, conventional can be just a lump sum upfront. It can be a split, and it can be a monthly charge that isn't for the life of the loan. It is until you build enough equity to get that removed. And so it's important because again, not every property is going to qualify for FHA. Not every condo may qualify for FHA. So this is where conventional financing comes in. And it is for borrowers who have some money to put down, whether that's 3% all the way to 15%, but less than 20. So it gives them the availability to our lenders to lend on that and be protected. So MI covers the loan, the lender. So the loan is insured. So they feel secure to lend out that money at the less than 20% down payment.
Thank you for answering that, and thank you for that amazing answer. So I don't think that a lot of home buyers and homeowners actually understand that up until mid-60s, they couldn't even buy a home with less than 20% down because mortgage insurance did not exist back then.
Correct.
And please forgive me for not remembering the exact year and month and date when the mortgage insurance came into being, but effectively back in the 60s, when the mortgage insurance was introduced, the private mortgage insurance was introduced as an option, that's what really opened the floodgates to home ownership in this country, because that's what allowed people to come in with very little money down and allowed them to buy a home while protecting the lender, the banking institution, the investor from the loss.
Absolutely. So it has opened the gates, as we said, that you can get into a home without waiting, because when we've done the statistics, you waiting for the more down payment
prices you out.
Absolutely. And the increase of the house is exponential. So you lost out on the house saving for the down payment, which I think a lot of clients are stuck right now.
Yep.
They want to save more money. In the meantime, the prices keep going up.
So let's say, just for round numbers sake, let's say a typical $400,000 home that appreciates at 5% a year. Again, I'm taking kind of an average number, not pulling a pie in the sky, but its really appreciation rate is somewhere around 5% nationwide. So 400,000 times 5%, that's a $20,000 increase in just 1 year.
Yes.
So now instead of 20%, if somebody's trying to accumulate the 20%, instead of the 20% accumulation for down payment on 400,000, that's 80. Now at 420, you're looking at 84,000.
Correct.
And that number keeps on going up and up and up every year. But what also people lose sight of is that not just the homes appreciate now, and they need more money for the down payment if they're trying to reach that 20% mark, but also now the home price has gone up, their loan amount has also gone up. So now they may not even be able to qualify for that loan. Mm-hmm. So the waiting game is not necessarily the best game, and trying to save up for the 20% down payment is not the best game. That's really the bottom line.
Absolutely. The waiting game is never the best option in this market because, as you said, the rate that it's expanding, we can't catch up to it. Where, again, coming up with the 3 or 5% is enough to get into a house.
And it's a lot more feasible financially.
Yeah. And also, if people are selling a home, they may not want to put all their assets at the 20% because, as you said, things are more expensive. So can that go towards furnishing your home? Can it go towards landscaping your backyard?
Paying off debts.
Paying off debt. Having a safety net, a savings account. So sometimes you have to off-weigh that. Mm-hmm. We're paying this monthly minimum charge and still having money left over is important. And closing costs have gone up.
Yep.
Insurance has gone up. Taxes, HOA, all these things.
Everything.
Absolutely. So we have to have those reserves. And that's why it's important because we never want someone to be house poor, to go in and putting every dollar down in their house. And then there's a catastrophe awaiting. So that's where mortgage insurance gives freedom to the buyers. And even though it's like with any insurance, you're paying for an in case. And so again, it's important to just know your options. And that's where having a secure, good loan officer can review those options. They may be a different option, whether it's VA, FHA, or conventional, but it's not one size fits all.
There is no such thing.
Exactly.
There is no two identical scenarios.
Absolutely.
In 29 years of doing this, I haven't seen two identical scenarios in my entire career because there's always a zing.
Yeah.
There's always something. Mm-hmm. There's always a catch.
Yeah.
So people can understand better. Can you explain exactly what mortgage insurance does? Because I think that that's where most people will either deer in the headlights on me or just simply don't understand.
Absolutely. So private mortgage insurance insures the loan, the lender, not the borrower. That's your hazard insurance. So those can be very confusing. So hazard insurance, homeowner's insurance protects your home, your dwelling. PMI, private mortgage insurance, protects the loan. And so again, it protects the lender so that they're secure of default. And it's important to know those differences. You also cannot select PMI as the borrower. You can select your homeowners. That's again where you have your loan officer who looks at that, does the pricing, and works with us. So it's all in the back end, but it's very important because if the realtor and loan officer don't understand that, PMI can kill a deal.
Yep.
So they have to know how to ensure that. And so that's where if you don't have a seasoned loan officer, they don't realize, like you said, no deal is the same. It's different for 2 borrowers versus 1 borrower, self-employed borrowers versus 1 borrower. Zip code changes everything. So if you put a generic quote and then run it through, it's a whole different scenario. So again, that's why it's important to work with a reputable loan officer who knows that. Because even though we're on the back end, we're a very important piece of that.
Absolutely. And something else that I think catches, and we'll come back to this actually, and we'll talk in more depth about what drives the cost of mortgage insurance and actually how affordable the mortgage insurance can be, which also a lot of people don't realize. But before we get into the nitty-gritty, let me ask you another question. One of the very little understood quirks about the mortgage pricing, meaning mortgage rates, is that not having PMI, putting 20% down, actually yields a higher interest rate than putting less money down or putting significantly more at 25 or more percent down. So that's where so many buyers and borrowers think that it's completely illogical that the interest rate is higher at 20%. And like I said, they don't even realize it. But I show that to all of my clients up close and personal when I do the number Zooms with them and walk them through the numbers. So let's talk about that for a second.
There's no insurance. So it's a stronger loan when we have that insurance to the lender and to Fannie Mae and to Freddie Mac.
So don't just take my word for it when I talk about it. Here you have an actual MI company rep actually speaking the same words that I say, except for she said it a hell of a lot nicer. Because I literally tell people that 80% loan, meaning 20% down payment, is the first point of no return for the lenders.
Yes.
Where they literally leave their behind flopping out in the wind without the insurance.
Absolutely. So again, there's not that security blanket, but then that also takes from your reserves. Fannie, Freddie, the GSEs, they like to see reserves on a file because again, if there's a hazard, if something happens in the home, if income, overtime, bonuses changes, so things can always happen. So having reserves is very favorable in the loan process. They would rather see you have some assets left over than putting 20% down.
So again, if you keep on watching, by the way, we're going to talk about the removal of PMI towards the very end of the video. So if you want to know more about that, stay with us because we'll get to that subject. But we have a lot of ground to cover before we get there. Once again, just so that everybody understood, the security blanket, again, love the way you put it, of mortgage insurance gives you a lower interest rate when you put less money down. So as illogical as you thought it may be, it actually is not. And it's actually a fact that putting 20% down will give you a higher interest rate. Putting less money down will give you a lower interest rate.
And I think that's the importance of that you're thorough. Like you said, you're giving them all the options for them to then make the decision. But sometimes I think clients can be pushed into FHA or they can be pushed into 20%. And it's really important, like you said, because every client is different. It's just letting them know, what does it look like with 10% down if you're going to put 20 and then you can furnish your house and have savings? What does it look like at 15% down? And then if the seller doesn't pay the closing costs that you thought you'd have money left over? What if the appraisal comes in lower and you still want the property and you have that appraisal gap where you have to insure more of the house? And that's where MI will help you. So maybe you were going to put 20% down, the appraisal came in higher or lower, and now you have to adjust that loan to value. So again, I think it's great that you know that because you've been in the business, and that is going to be the differentiating factor for your clients is going over their options, because sometimes I think they're just handed this option and they don't break it down in the long term like you just did.
I feel like usually it's not just the less experienced loan officers. I also feel like it's more the bank LOs and the call center LOs that are not really about doing the options. They're more about the turn and burn. The more transactions they close, the more they make. So they don't really care as much. Do you think that's true, or what's your feel on that?
I think that can be in all fields, but yes, it's taking that extra step because you're right. It is going to be more information, more thorough. But if we're keeping the client's best interest, you're absolutely right. We need to take the extra time because you never want someone to come back and say, I didn't know there was an option of 5% down, 3% down. And every time we do a study, we're astonished how many people still believe you need 20% down.
It is insane.
Insane. And they think first-time buyers is 3% down, but that's not necessarily the case. So there's a lot of education that needs to happen. So thank you for making this podcast. Thank you for making that information available. Because as much as we're out there, they're trusting you. And so you're the one.
Sometimes.
But you're the one delivering this information. So if the loan officer just doesn't know, they don't know what they don't know. So that's why it's important that we go over every scenario so that we're putting each client in the best scenario for them.
One of the mortgage insurance related questions or issues that arises when I talk to clients is the client not understanding that there is more options on mortgage insurance than just your garden variety, as I call it, monthly mortgage payment. Again, some of it is experience. Some of it is having the expertise in what we do, having honed that expertise over decades, over many, many years, where what is the best option? Asking the right questions, asking your long-term goals, asking how long you're going to be in the house to present you with the options to consider. And this is where the comment comes up with clients over and over and over again, especially over the last probably 5 years, is nobody ever told me that there were other ways to pay mortgage insurance besides the monthly. So I know you've already touched on the monthly, the split, and the single. So
absolutely. So
bring that home.
Yes. Okay. Literally, let's bring it home, right? To owning a home. Love that. So the most common is monthly. And that will, again, depend on the loan to value, the down payment, the credit score, zip code. That is the most popular and easy to go to. But yes, there are other options, especially when builders or sellers are paying all of the closing costs. You can pay it up front with the loan and then avoid that monthly. And Arch is also known for the Rate Star buy down, which is customizable MI. It doesn't have to be a 50-50 split. So what does that mean on the LO side? Is if you have money left over, you never want to leave seller concessions on the table, and you've already bought the rate down. You've put things into the closing. You can add that to the Rate Star buy down and then bring down the monthly. So it's a split. You can also, if you're struggling with debt ratio, the MI is just making that debt ratio, because once you go above that 43%,
it starts hiking up.
And so maybe paying off a credit card isn't feasible to bring down the debt loan. Maybe paying off, obviously, a bigger loan isn't going to be feasible, but paying down the MI might be the best option for you. And then you can see where you need your debt ratio. You go into our website and you toggle with it. And then you see, okay, if I want my MI to be X dollars, this is what I need up front. So it's, again, not one size fits all. And what's feasible never is. But it's, again, giving the loan officer options and a different monthly payment. If they're really struggling with paying that MI and the borrower just feels really frustrated with it, I understand that. Just like you shop homeowners insurance, you can look at the different...
We as loan officers shop across 6 mortgage insurance companies, and we actually pull up all of the options all at one time. So we pick the one that actually will do the trick. Now, it doesn't always, I know you're with ArchMI, the rest of them are your competition, but nobody's ever the lowest or the lowest every time. But it's also true, just like with anybody else, with anything else, the lowest MI rate does not guarantee that MI approval.
Absolutely. And what's the turnaround time? What are the red flags? What are the conditions that our underwriters are going to find? We have seasoned, experienced underwriters on staff that will pick up the phone. If they see something that's not panning out that could blow up later for you, they would pick up the phone. Ella, hey, we're seeing the income change. These assets don't add up. So there's things that we're going to catch that we don't go. So it's, again, responding quickly when you say, we need that rush. We need that closing. We have a short close, that your MI rep, just like your realtor, your title rep. You pick up the phone and say, Annabelle, let's work through this. And that I think that's the difference too, is having a true partnership where we all want to grow this community and help fund more loans.
Absolutely. Now, one of my favorite tricks in the book is tricks in a bag. I'm mixing them in.
Secret to success.
Secret sauce.
Yeah, secret sauce.
Is the single premium mortgage insurance, and not necessarily paid by the seller, because most of the time we're already tapping out all of the seller credit. But it's more of the single premium mortgage insurance that we actually wrap into the loan, meaning it's financed single mortgage insurance premium. And typically anywhere from 6% down on, it does the trick. It wipes out, same thing with qualifying. It wipes out the monthly mortgage insurance. It's wrapped into the loan. Yes, it bumps up your loan amount slightly, but FHA does that already. I mean, that they have their upfront mortgage insurance premium that adds into it, and you have the monthly portion. Here, we're taking it all into the single premium, wrapping it into the loan with a bow, and now you don't have a mortgage insurance monthly payment line, so that actually helps you qualify. So that's been, again, one of my secret sauces over the last umpteen years, where it's tight on qualifying, especially with the current rates and especially with the current home prices. And when you combine the two, it's a recipe for disaster sometimes. So that's one of the ways to actually get more home, or the home that you want, versus the home you can qualify for. So that has been one of my favorite tools. And again, not too many people talk about that option, and not very many. I don't know that a lot of loan officers actually understand the advantage of it, but I know for a fact realtors don't know enough about it, and the general public, the consumer, even less so. So when I start having that conversation that you have options, that's where everybody goes, well, nobody ever told me.
And I love that you said wrap it in a bow, right? It's a one and done. You pay it up front. And that's going to give your buyers the advantage. So if they're that maybe that helps them qualify for a few thousand more. And right now, when you are so competitive and buyers, so every bit helps. So if that allows your borrower to afford more house because they can have a higher monthly payment, that is going to differentiate them from another buyer. So again, it's going over those options. We always start off, we're going to buy this house, but then we see this other house and it's a little more. And then everything's more in it, right? The property taxes are more, the HOA is more, the homeowners. So you're fighting for every dollar in that monthly payment.
Exactly.
So if they want that extra little bit more house that they weren't planning on, that's where MI can also help you, because again, you can lower the down payment or pay for it up front. So that's going to give your buyers the advantage of you knowing your secret sauce, those tools to help you.
And it makes a huge difference,
Absolutely.
actually. Not to mention that when you do a break-even analysis on doing a single premium financed versus paying the monthly payment, usually break-even is somewhere around 3.5 years. I mean, it's always give or take 33 to 42 months. I mean, it's like it never fails.
Yeah.
I run the numbers and every freaking time it's about the same. It's about 3.5,
which is,
well,
I think,
less than 3 to 3.5 years. And it does make all the difference in the world.
Absolutely. And I think that's the difference, like with buying the rate down with points. Well, you're doing it already.
Exactly.
So sometimes they just need to apply that math to, like you said, to the MI math.
That's a great analogy. I never thought of using that in terms of explanations.
And they're doing it already. So it's just, again, like you said, changing that concept of MI, changing the stigma of it. It's a very important part of lending. It's a great option. Again, it just gives your buyer more things to choose from. And then they have the ability to see what works best for them. And that's going to change throughout the process. We know that,
does.
Like we said, they're going to be adamant that they are going to put 10% down. But then again, things change. The property changes, the offers. So knowing the save the deal, in a sense, if that's your rate star buy down with the MI customize, if that's up front, it's again looking at options as the loan process changes, because like you said, it always does.
It always does. Sometimes it'll start out with the pass A and end up on the pass Y.
Yeah, A, B, C, D, everything. Absolutely.
So everybody knows how to calculate their payments online, presumably. And everybody's seen those payment calculators when you go look at home on Zillow, on Redfin, on Realtor.com, or use an online mortgage calculator. And all of those spit different numbers when it comes to mortgage insurance. So case in point, talking to a buyer just about a month ago, having a conversation about mortgage insurance and how to avoid it. They were telling me that they really didn't want to pay the $2, $3, or whatever $100 per month it was. I'm like, well, how did you come up with that number? What you're seeing online, on Zillow, on Redfin, and I'm not knocking either, because they are kind of giving you not quite the worst case scenario, but they're kind of giving you the upper side of the spectrum. Forget what you saw. First of all, I'm going to provide you with my payment calculator, and it's going to be a lot more accurate, but also I'm going to run the pricing for mortgage insurance, because again, just like everything else in the mortgage realm, there are no static numbers. Nothing is one size fits all. Everything is customized to you, the buyer, specifically based on a number of factors. And I've seen the mortgage insurance monthly even being as low as $79 a month on a $500,000 loan. But then I've also seen it as high as $600 a month on the same size of a loan. Let's talk about what affects those monthly and, as a result, single premium or split premium rates. Because again, this is where the conversation usually takes a turn into the completely unknown territory for most buyers, until I start breaking it down to them that mortgage insurance will be driven by a number of factors. I can't tell you how much is going to be upfront, pun intended, as upfront premium or monthly premium, without plugging it into the mortgage insurance calculators. The only one that's standard, well, two that are standardized are FHA and USDA. Those FHA is 0.55 annualized factor or 0.50, depending on how much money you're putting down, and the 1.75 upfront MI that's financed into the loan, or as I referred to before, wrapped into the loan with a bow. USDA has a similar concept, 1% wrapped into the loan, and 0.35 annualized that translates into a monthly payment. But on the conventional side, on the private mortgage insurance side, there is no such standard. Everything is literally hella individual. So what drives the cost of mortgage insurance? And I know you mentioned a couple of times, but let's take a deeper dive and list all of the factors so that actually the buyers have a better understanding of what goes into it and what can affect it, so they can actually tighten their budgets
Yeah.
and be in the know.
Well, and I think that's a good point that you made, is going online is not going to give you that information, even with homeowners insurance, with hazard insurance or PMI. So those are the two unknown variables. And it's good that you said that, because that can be way off and that can completely affect the loan. So we have some similarities to hazard insurance, but there are some big differences. So of course, the main thing is the property type. Whether you're buying an investment property, a vacation home, a primary residence. Down payment, are you putting 3% versus 5 versus 10, 15? You're going to see those increments completely change.
And it's 5%, it's 3% down for conventional, and then it goes in 5% increments until basically you hit 85%, meaning 15 down, or 20% down, 80% loan to value. So on the mortgage side, we'll look at everything actually comparatively backwards, because we look at the loan to value portion, not your down payment portion.
So the property type, how much down payment you're putting, obviously credit score is going to affect you. And then again, the zip code, that's going to change for every property. Self-employment is going to change because that's a different type of loan normally than a W-2 employee.
And self-employed is perceived as more risk.
Obviously, yes.
Unfortunately, it is the truth. Self-employed people are not, redheaded stepchildren of the mortgage industry. I'm sorry. But I'm the first one to admit it. And we all know that somebody who's self-employed somebody who's got entrepreneurial spirit will always bounce back and figure their way back home. Whereas somebody with a W-2 job, once they're let go, it may take them forever to actually
and that's a
come
good
back.
Point. And that's why
industry-wide, though, self-employment is considered to be a risk factor.
And I think that's what's also good about MI is there's layers.
Yep.
So we don't just say self-employed.
It's like peeling an onion.
Absolutely. So we don't say self-employed high risk. No, we look at the layers of it. Yep. We look at a couple of things. Exactly. And also how many borrowers. In our case, 2 borrowers is stronger.
That's the piece I actually never understood.
Yeah,
I was waiting for you to say that because that is the piece I do not understand to save my life, because I've seen it firsthand where we'll add a spouse who does not bring anything to the table income-wise.
Yet.
And yet, the mortgage insurance drops considerably when you bring in a second person, even if they have no income to bring to the table.
As long as their credit is the same or better.
Or better.
And I think it's the philosophy of 2 heads are better than 1. There's a family, there's a unit.
Split the risk?
Yeah. So I think statistically we've seen that's just a stronger file. So I don't know about in your time doing loans, but we always kind of try to do less. So if 1 borrower qualified, we kind of left it at that.
Exactly.
But it's different on our side. So if there are 2 borrowers, they have similar credit score, I always suggest running that quote, because that might make a difference with that. So
once I've learned that, I start plugging that in.
Yeah.
But that's a fairly recent actually discovery. I mean, we're talking just, a handful of years as opposed to 20 some.
Yeah. Again, property type is important. Down payment is important. Credit score is important. And then if you have 2 borrowers, and then self-employment versus W-2 employees.
And there's another big one.
Yes. So those are all layers.
Yep.
And again, what type of loan? Are we looking for investment, second home, or primary residence? So when you're entering that matrix, it's very important, again, that you have a detailed loan officer that marks all the correct boxes, because those numbers can change. And it's the same when you request a hazard insurance. If you're saying this is primary residence versus a second home, if you're saying it's a condo versus a single family home. So again, you have to have a loan officer who's inputting the right information, and it's going to give you the most accurate, close estimate to the insurance quotes.
So there's one more factor that you didn't touch on that I wanted to ask you about. And I've seen that one factor by itself. Yes, it's a layering. Yes, it's an onion. But this factor has thrown me for a loop as well, because it plays a huge, huge role in this very steep increase in the mortgage insurance cost, and that is the debt to income ratio.
Oh, absolutely.
It changes dramatically.
Absolutely.
I've noticed that if the debt to income ratio is below 43, it's a mwah.
Yeah.
It's good down payment, decent down payment. And good down payment in my book is 5% or more. Credit scores, let's say, the higher the better, but 740 and up. But then once you start tweaking the debt to income ratio, that's where I see the mortgage insurance skyrocket.
Well, and that's with anything. So you can have an approval, run it through the automated system, and then your debt ratio changes, and it won't matter if you have an 800 credit score sometimes.
True that.
So debt ratio is a big factor in all of it. And that's important that you talk about that. And it's good that you're explaining that, because sometimes people look at their whole overall debt, as you know, and it's not, it's the monthly payment.
Yep.
So you can have a smaller credit card, but an astronomical interest rate, and that monthly payment can affect you more than that larger loan that you thought of.
Or you can have a small loan that you took out for 3 years.
Absolutely.
And now your payment is up here.
Yeah.
Because you want to pay it off faster.
Yeah.
Great. But it's killing you when it comes to
and I
getting
think
a
that's
mortgage.
where the mortgage industry has changed, and people have to acknowledge that you have to fit every piece of the puzzle, as we see there. So it doesn't matter that you just have good credit. It doesn't matter that you just have assets. If the debt ratio is out of balance, it brings the whole file down.
Yep.
So that's in your approval, that's in your interest rate, and yes, that's absolutely in your mortgage insurance. So it's, again, you guys, loan officers, having that discussion and the importance of shopping their homeowner's insurance, the importance of where their debt is and understanding that in the process, because they'll say, oh, I need to pay this off because it's the biggest debt. And yet it was the smallest monthly payment, and it did nothing for their debt ratio. And that's also where conventional financing has an advantage of, okay, instead of that 20% down, what does it look like to pay off the highest monthly liability and then put less down? So you're absolutely right. Once you're over the 45% debt ratio, it is going to be harder to finance.
And
it's
the
going to
higher
be
it gets, the more costly it is. So it's multiple factors. And it's, once again, not one size fits all, because there's been multiple instances on my files where we start out with a quote for mortgage insurance at X, and then something changes in the process. A piece of the income doesn't get approved, or the buyer doesn't have as much money down or in reserves as we originally planned on. Life happens. But that also happens to be changing the mortgage insurance factor, which, of course, that in turn affects the total payment and the total qualifying.
Yeah. Absolutely. And I think you'll find similar that what you're seeing on the loan process, you're going to see on the MI side. If it gets riskier for you, it gets riskier for us. So once your debt ratio goes up or the property changes, your automated underwriting can change. Your approval process can change. The amount of reserves can change. So we work hand in hand. There's really nothing that's going to be a big flag for us that shouldn't be for you, because we work hand in hand with that. And so we're seeing the same things you're seeing. So when you see something change on your side, most likely you're going to see it change on our side. And what you see stronger on your side, you see stronger on our side. So of course, if we see longevity, if we see good payment history, we work hand in hand. There really shouldn't be opposing ends to that. We're all going towards the same goal. And so when you see something change on your side, you're going to see it on ours. But you're absolutely right. Debt ratio is a tough one right now, especially in this economy. And so it's important to have those conversations up front. And I'm glad you're doing this before tax season, because so many people want to rush out and pay something off. And so,
it's like I always tell them, don't pay anything off until you talk to me.
Absolutely. And that's something that, we need to educate, is just hold on to it. And then let us look at your whole picture. And then let's look at what works. Because again, they just hear, approval. They just hear down payment. They just hear debt ratio. And they don't really know how that breaks down.
It's like buzzwords.
Exactly. And how that's going to affect their whole process. So I'm glad that you're doing this before tax season, and people get a down payment sometimes through that, or pay off debt. But yes, the biggest thing is don't do anything until you talk to your loan officer, and then let's see where you fall and how we can work that loan in your best interest.
One of my not so favorites, I was going to be very sarcastic, but chose not to, and sarcasm is my go-to, is when financial advisors, some financial advisors, financial planners advise clients also to put 20% down. It's like educating even the financial advisors and financial planners that the 20% down does not necessarily get you to where you want to be. Sometimes putting 15% down, but getting a better rate and doing a single premium mortgage insurance buyout or finance single premium makes more sense.
Absolutely. And I think that's the narrative. That's what you're saying. Like, we need to change that narrative, because how many parents told their kids, oh, don't buy until you buy 20%. By that means you're not going to buy a house for 10 years or more. Or 20 years. So we're changing the narrative, and it's so important that we have this education. So again, thank you for offering this, because that is the difference of being a homeowner now versus a decade from now. So we need to change that narrative of you need 20% down. You have to have perfect credit score. You can't be self-employed. You can't be a single. There's so many narratives that are out there that just aren't true. And the 20% is the huge stigma that we all are trying to educate, because the important is to become a homeowner as quickly as you can, because you're going to gain the longevity of building equity, but also the sooner of removing MI as well.
Exactly. So the piece of the recording, the piece of the video that everybody is on the edge of their seats for. I know this is such an amazing and exciting topic, mortgage insurance. I mean, come on, right? But the reality is that everybody who has mortgage insurance wants to know at what point they can get it removed.
So the rule of thumb has normally been about 20% equity. Now we know with the market changing, that can vary from 2 years to 3 years. But the biggest indicator is through your servicer, your lender. So you would contact them directly and they would set that up and request that from us.
So let me put a pin in it for a second. Let me repeat that so that everybody hears this loud and clear. It's not the mortgage insurance companies that dictate when the mortgage insurance comes off. It's the actual lender, i.e. technical term, servicer. But really, it's whoever you write your monthly mortgage payment to. Now, law-wise, your mortgage insurance, private mortgage insurance, will drop off automatically when your loan to value, meaning the balance of the loan that you have as compared to the original purchase price that you financed on, gets to 78%, meaning you have to have a 22% equity in the house. That is the point where mortgage insurance is going to drop off absolutely automatically without you having to do anything about it. At 20% equity, you can request removal of mortgage insurance, but you have to do so from the company, the lender that you're making the mortgage payments to, because they decide based on what?
So well said, Ella. Thank you for clarifying that for the bars. So the lender will then reach out to us and request a cancellation. And that's up to each lender. They may look at the payment history. They may run an appraisal. They may run a comparative analysis. So they're going to look at what the values, because you may think your value is something, but what do the comparables show? So that's going to be your biggest indicator. But we're insuring the lender, not the borrower necessarily. So that's why the lender has to decide that. They're always welcome to call and ask questions, of course, but it is going to be up to their servicer, their lender, to request that. And some people also may do what's called a reamortization. So they sold another property, came into a lump sum of money, and now they want to reamortize their loan. So there's
a recast?
Recast, absolutely. So again, they would go to their lender, servicer, and say, can I put this money down? You don't want to refinance it because maybe you got a great rate, but you want to change the term of the loan, the monthly payment of the loan, remove MI. So those are all, again, why it's important to have a good relationship with your loan officer, because you know their situation. Mm-hmm. They're pending a sale. They're changing careers. Like, so many things can happen that change it from when you first buy the home. But again, if you have a loan officer you trust, you can go to them and say, this is where I'm at, but this is where I think I'll be in a year or 6 months. And then you again can present those options, because how many people don't know that? And so that property ends up selling, a second property they have, and now they have a lump sum where they can't put the rest of the 20% down. So you can request it before they hit that loan to value.
So the bottom line again is, and thank you so much, Annabelle, for explaining that, because not many people consider that. Everybody is all about right now. Mm-hmm. Instant gratification, unfortunately. But there's a lot of planning that can be done to get you into a better position, and a little bit of effort.
Absolutely.
But the bottom line is that when you ask me as a loan officer, when you can remove your MI, I'm going to give you, it's probably one of the very few times when I'm going to give you an absolutely canned standard answer. 78% loan to value, 22% your equity. That's when it drops off. 20% equity, 80% loan to value is when you can request cancellation. At what point you can do that will be determined by the lender. Talk to your lender, request their mortgage insurance cancellation packet. I can try and help you translate that from mortgagees into English, sometimes into Russian.
Into Spanish.
Or Spanish. But it's entirely up to the lender. The good old days of, I'm going to reappraise my house, send the appraiser into the lender, and get the mortgage insurance removed in 2 years, 3 years, whatever, which that happened prior to the crash. That was happening right and left. That is no longer the case, because guess what happened in the crash? So many lenders let people remove mortgage insurance, and then the crash happened. And then those homes foreclosed. And the lenders were not protected by the security blanket of mortgage insurance. And that's what caused the change in all the rules all across the board and everything that's real estate related.
And it's like you said, it's all across the board. I think it's also, as you mentioned, having accurate information. Yes, there is a lot of information out there, but check the website. Like ArchMI does a really good job of having materials for the consumers as well as the loan officer.
And what is that website?
ArchMI.com.
Perfect.
And there's the home buyer guide that's free that they can download in English and in Spanish. But I think it's important even for realtors to see, because sometimes the borrowers will ask them.
Yep.
And like you said, everyone has their field of expertise.
Yep.
I by no means will give loan information. That's up to their loan officer. Vice versa, the realtor has their place. But go to the MI webpage. It'll tell you.
Go to the source.
Exactly. Go to the source. So ArchMI.com has the cancellation policy, has the home buyer. So there's things on there. It explains income. So there's so many great tools for the loan officer and for the consumer free of cost. So we want to give accurate information and get them as well prepared as we can to be a homeowner.
That is awesome. That is probably the best piece of advice that you can get from my videos so far. Like, bar none. I so appreciate you coming, Annabelle. I so appreciate you talking through it. Is there anything else you want to say about MI?
Again, like you said earlier, MI is your friend. We're here to help you. And so again, it's changing that narrative, just being educated, knowing what your best option is, and not listening to your neighbor or your friend or even your parents on what their option was, because everyone has a different scenario.
Oh, some idiot expert on TV.
Well, if they're an expert, they're not an idiot.
Some of those TV experts are idiots.
Okay, well, we're not.
I meant us. We're not on TV.
So it's, again, working with credible, honest people, good loan officers like yourself who aren't just pushing numbers through. It's walking and getting to know you individually and what your best scenario is and running those different options with you. And as a consumer,
your uncle's scenario may not be your scenario.
Yeah, and as a consumer, don't be afraid to ask. Don't be afraid. Like you said, what is MI? When can I cancel it? Why is FHA? What is VA? What is USDA? What can I do? What program? What house fits? It's going through that with you. What does 5% look down versus the 10%? What is my overall? What are your goals in your house? One house may be ready to go. Another house may need landscaping. What are your family situation?
Updates. I mean, who knows?
Yeah. What is your family situation? Like, I know personally, I have a daughter in high school who's going to be driving, and I may need to put less money down on something as opposed to a couple years or when she was a toddler. So that's where you get to know your client and you give them the best scenario. And so it's asking those questions and getting the information from the loan officer, the source, as you said, not just what you're reading or hearing from other people.
That is awesome. Again, thank you so much, Annabelle.
Thank you.
I really
Such a
appreciate you
pleasure.
sharing your knowledge and paying me such high compliments. I appreciate that. But it is all about educating. It's all about getting the true information, the correct information out to the world, because there is so much misinformation and so many myths and misconceptions out there that I'm just trying to tackle like one myth or misconception at a time. And mortgage insurance has been probably the most mysterious and shrouded in darkness subject that most people just want to avoid. But there's really nothing scary. It's just a tool, and a useful tool, just like so many other tools. So that's where expertise like yours comes into play. And again, thank you so much for joining me today.
Thank you for having me.
Absolutely. See you on the next one.